April 11th. We have about a month of the session left. We're going to take have a little bit more conversation of diving into S45 to understand sort of who it impacts. And I think Abby has some answers to some of our questions that we had last time she was here. And then I'm hoping to come close to finishing up S94 this afternoon. And then for the rest of the week, we're going to take a lot of time on financing childcare while sort of in parallel to the Human Services Committee working on the childcare bill, as well as a few loose ends about funds and fees that we've sort of picked up as the session has gone on. Any thoughts, announcements, hopes and dreams? Anyone want to share? Okay. With that then, Abby, are you there? Hello.
Hi, I am here. Can you hear me okay?
Yeah.
Great. Thank you. For the record, Abby Shepherd, Office of Legislative Counsel. You will see there are two documents under my name. I don't have a presentation for today because my testimony is really just answering some of the questions that came up when I did the walkthrough. So there is the section by section and then the actual bill that was passed by the Senate. So just to remind you, I know I don't necessarily retain all bill numbers. S45 is the SALT deduction cap workaround bill. So it's a pass-through entity tax and then a credit. And that's to get around the Tax Cuts and Jobs Act limitation that was put on individuals so that they can no longer deduct more than $10,000 of state and local taxes paid. So this would create a Vermont structure to have a workaround for that federal limitation. And the primary question that I was coming back to answer was about the second credit, because there are two credits in this bill. The first is the direct credit, the state level credit against the entity tax. So again, to remind you, this would create a state tax on the pass-through entity, and then there would be a refundable income tax for members of the pass-through entity, so either shareholders of an S corporation or partners of a partnership or owners of an LLC. It would not be available to sole proprietors because there's no entity that would be taxed in that case. So there's that refundable credit. And then the bill also includes a credit that would be non-refundable also on personal income tax. And it would be for taxes that are paid to other states. Vermont already has a credit in statute for personal income tax that is for residents who pay income taxes to other states. And that's to avoid being taxed on the same income, both in Vermont and in another state. So there were questions about why would there be an additional credit created under this bill? And that's what I had started to answer and hadn't fully prepared at the time to talk about the state of other states' credits for when they either have or do not have a pass-through entity tax. So that's what I wanted to come back in to talk to you about. So I'll just pause right there if there are any questions just about my sort of framing of the issue. Don't know if everyone remembers that discussion.
I think we're good.
Okay.
Yeah, thank you.
So the sort of legal issue behind this goes back to a constitutional, US constitutional issue. So as I started to explain, for the existing credit in Vermont, there is this credit against taxes paid to other states. So that aligns with the Commerce Clause under the US Constitution that has an internal consistency doctrine that's been built in case law around the Commerce Clause. So state taxes need to be structured so that they wouldn't be imposing a tax on the same income that another state would be taxing if every state had the same tax structure. So most states do have an income tax. Not all states have a personal income tax. And those states that have a personal income tax generally have some sort of crediting mechanism when that same income is being taxed by more than one state. So you'll be familiar with this in a lot of the discussions last year on corporate income tax. There's apportionment and allocation to ensure that, it's properly being attributed to the jurisdiction where that state has authority to tax the income. So it identically for personal income tax, there is this crediting mechanism so that the person is not being taxed twice on the same income. So because I think your question was, well, then why would you need another credit? Because Vermont already has a personal income tax credit for income taxes. Almost all of the states that have created a pass-through entity tax, so this is creating a new tax at the entity level, have also enacted, and there are a few exceptions, but almost all of these 30 states that have enacted a pass-through entity tax have created a separate credit or other mechanism. I'm going to forget which state it is. It's Louisiana has a more of a deduction mechanism to ensure that when an individual is paying through a pass-through entity tax in another state, they are able to get a credit in Louisiana for that, or deduction in Louisiana for the state where they are a resident. So you're looking at double taxation where I don't really like using that term, but taxation in two different jurisdictions where there's cross-border activities and income from more than one income being derived in more than one state. So first, where the activity is happening, where that income is being earned, that's in another state. And then the owner, who is a resident of, say, Vermont, is also being taxed in Vermont. So that's where the credit comes in to create a situation where they're not being taxed in two different jurisdictions. So I hope that clarifies some of my testimony from last week. And then I had prepared what other states with pass-through entity taxes do and how they've structured that. I have a few examples. And then I wanted to clarify how some states that do not have a pass-through entity tax, how they have either allowed or not allowed entities to take a credit under their existing personal income tax credit. But I just want to make sure that the sort of legal requirements are clear.
I think we're good.
Okay.
Okay. Or at least we have no questions. I don't know if,
okay. So for other states that do have a pass-through entity tax, Maryland is one example. They do have a credit for resident pass-through entity owners, and that's based on the owner's pro rata share of the tax that the pass-through entity pays to another state. New Jersey also allows for a credit. They do have a pass-through entity tax. They allow a credit for another state's tax that is determined to be substantially similar to the New Jersey pass-through entity tax. And Vermont's language uses similar, this proposed language would use similar language around it being a substantially similar credit or tax in order to get the credit. Rhode Island allows a credit for similar taxes that are paid to another state at the entity level. Again, this is only for residents. And it does sort of bake that into its existing personal income tax credit for taxes paid to other states. Interestingly enough, Wisconsin doesn't have a statutory credit for their pass-through entity tax, but administratively through their guidance at the administrative level, Wisconsin residents are allowed to take a credit for pass-through entity taxes paid to other states. I mentioned Louisiana. They have recently enacted a pass-through entity tax, and their mechanism is an adjustment. It's not a credit. Part of the discussion when I was in last time was relating to Maine and Massachusetts. So I just wanted to clarify and focus on those New England states to explain how they are treating pass-through entity taxes paid in other states. So a lot of this discussion, and there has been litigation and there has been some administrative guidance put out by Massachusetts, it hinges on the characterization of the taxpayer. It doesn't seem to be any really a live issue of whether the tax is an income tax. So it's very clearly being based on income. But the sort of live question here is whether a pass-through entity tax paid by an entity in another state is eligible for a personal income tax credit in their state of residence. So whether or not it's limited to an individual in each individual state statute determines whether that existing credit applies or not. So Massachusetts and Louisiana, they have now enacted their own pass-through entity taxes, but prior to enacting those, they found that those taxes were, I'm sorry, I'm reading through this. Massachusetts did find that their pass-through, that their personal income tax credit did apply for New Hampshire partnerships, even though they were paying an entity level tax. So now that Massachusetts has enacted their own pass-through entity tax, they do not have a specific credit relating to pass-through entity tax because they had already determined that their personal income tax credit was available to members of entities that are paying taxes in other states. Maine does not have a pass-through entity tax, did sort of, their court found the opposite. They found that the Maine personal income tax credit applies only to income taxes paid to other states by individuals. So if it's a business entity paying a business level tax to another state, Maine does not allow their personal income tax credit to flow through to its Maine resident owners of pass-through entities.
Abby, will you, I'm not taking very good notes. What was the state before Maine?
Massachusetts.
Thank you. Back to you.
And Massachusetts does now have a pass-through entity tax. Maine still does not. And I do want to highlight the way that, just as a comparison, Maine's statute is similar to Vermont's in that Vermont is also explicit that the existing personal income tax credit for income taxes paid to other states is for a resident individual estate or trust, and it's upon the taxpayer's income earned or received from sources within that state, that other state. So it would be very similar to Maine and could be interpreted in the same way that Maine interpreted its credit, in which case Maine found that a business paying an entity level tax to another state was not eligible for the personal income tax credit. I'm kind of harping on that because S-45 goes beyond just the existing statute and would create a credit for taxes paid to another state. So I don't have any sort of grand conclusion. I feel like I've talked a lot and maybe used too many words. I don't know if there are any questions or if I could clarify any of that.
I think that was the right amount of words and really helpful for me at least. Anyone have any questions? Okay. Thanks, Abby.
Great,
Really
thank you. And I will stay on the Zoom if there are any other questions. Be listening to testimony.
Thank you.
Thanks.
Ted, do you want to join us?
Sure.
So I asked Ted to dive a little deeper into essentially who has income through a pass-through that would be experiencing the impacts of this bill. And so that's sort of the context.
Sure. For the record, Ted Barnett, Joint Fiscal Office, and I'm here, as the chair said, to talk at a higher level about business income and taxes in the state of Vermont and kind of compare and contrast corporate income and pass-through income, and also look at where that income accrues across different AGI groups. So to start very high level, with business taxes in Vermont, Vermont, like the federal government, treat taxes on income and profit depending on how a business is structured. There are two different characterizations, it says on the slide. One is as a pass-through business. The profits from that pass-through business are divided amongst shareholders depending on shares of the business, and then owners of the business pay taxes on the personal income tax code. And in the same way, someone earning salary or wages would. Corporations are subject to the corporate tax. And so I'm going to start on the pass-through side. This slide may look familiar. I've gone through it before, but pass-through businesses, their profits get passed through to owners who pay on their own personal income taxes. There are three different main types. First is sole proprietors. All of the profits from that pass-through business go through a single owner as their own income, and they file a Schedule C. S corporations can have 1 to 100 shareholders. They're prohibited by law from being owned by another corporate entity. The S in S-Corp stands for Small Business Corporation, and they file a Schedule E. Partnerships, you have 2 or more individuals who own and operate a business. All of these owners have equal ownership rights, and they also file a Schedule E. And so just a few, to be really explicit, a few examples of how taxes flow through in these different business types. With a sole proprietor, 1 owner, and in this example, they're earning $100,000 in profit. Owner number 1 receives 100% of that profit, and they claim $100,000 on their personal income tax. And for an S-Corp partnership or LLC, in this example, S-Corp has 3 owners and $100,000 worth of profit. Owner A, they are 50% owner, and they claim $50,000 of income on the personal income tax, 50% of $100,000. Owner B is a 30% owner. They claim $30,000 in income on their personal income tax. And owner C, which is a 20% owner, claims $20,000 in income on their personal income tax. And so this slide, the background for the slide came from Abby, thankfully, in an email. Any summaries or misinterpretation is my own. But so this kind of comes from the question of why do we even tax? Why do we have this different type of tax kind of structure and have certain people paying on personal income if they're a pass-through business, or paying on corporate income with a separate entity tax if they're a C-Corp?
And I'm very obsessed with this because I think like a lot of times when we talk about taxation, whether that's, you know, in a payroll tax or corporate taxes or whatever it is, we're always think of like businesses pay business taxes and people pay people taxes. And that's not true in most places, but I think like the particular structure of businesses in Vermont makes that less true. And so I think this is interesting in the context of this bill, but it's also very interesting in the context of all the other work we do. So thank you for going deep on it.
Sure, yes, and I appreciate Abby's email on this because I did find the answer interesting. So to start, one of the main reasons is corporations are treated as a separate legal person, and this is different from a natural person, aka like a human. And this protects owners of the corporation from lawsuits because there's a whole separate entity that is created in law. And so as a result, corporations pay taxes at the entity level, almost like taxing this legal person. So compare this to pass-through businesses, which don't have this separate entity. And so owners, as a result, take on a different and greater degree of liability. And so they are taxed on their personal income because there isn't really a separate entity to tax necessarily. And then this is starting to change. Many more businesses, as I'll show in future slides, are structured as pass-throughs now. And many of these businesses have really complex legal structures. And so this has spurred the creation of entity level filing requirements for pass-through businesses to help with tax administration. A great example is the non-resident pass-through entity tax that one can take advantage of. So that's a tax at the entity level. It's available to non-resident owner or pass-through businesses. And I hope I captured that correctly. So I've talked a lot about how pass-through businesses pay on personal income taxes.
Just who are you saying is a tax administrator at the last sentence?
Yes, so a great example is sitting here on the sidelines is Commissioner Bolio. Yes.
All right, I just wanted to be sure.
Sure. And so to contrast with pass-throughs that pay on personal income, wanted to remind folks of the corporate income tax tables, starting with marginal tax rates on the income that is applicable to Vermont. Rates range from 6% to 8.5%. Depending on the amount of income. There is also a minimum tax depending on the corporation's gross receipts. And that minimum tax has 5 different tiers. These were adjusted last year in S3. And so because I like putting these into examples, in a hypothetical comparison between net income on a C corporation earning $500,000 and a sole proprietorship earning $500,000 in net income. Starting with the C Corp, they pay corporate income tax at the entity level, and that's $41,000, almost $42,000. And then at the owner or shareholder level, this particular person would pay a personal income tax on the dividends that accrued from those profits of $31,260. And so their total Vermont taxes, hypothetically, theoretically, there are many different tax types and ways that income can kind of flow through and get reported, but it would equal $73,000 for an effective tax rate of 50%. On the sole proprietorship, the corporate income tax doesn't apply because there's no entity there. And then on the personal income tax side, on that $500,000 of income, they pay personal income tax of almost $35,000. That is their total Vermont taxes for a 7% effective rate. And so the difference in effective tax rates in many cases has kind of spurred the creation or the development of many more pass-through businesses, as I'll show in later slides. So to connect this with S45, by creating a pass-through entity tax, which is paid at the entity level, S45 would treat pass-through businesses more like C corporations, which are also taxed at the entity level. The difference here is that the 90% PTE tax credit on personal income tax means that pass-through business owners would pay far less in personal income tax compared to current law. So it shifts a lot of that tax responsibility onto the entity as opposed to personal income taxes. And adjusting the size of the PTE tax credit would change the amount of personal income tax paid by pass-through business owners. For example, if you decrease the credit, then you're increasing the effective rate or the amount of taxes paid by pass-through business owners overall.
To understand,
Will you go back to those?
Yes.
understand how this is working, the splitting the difference. Do we go back to what Abby was talking about and try to figure out what other states are doing so we know who else is doing something like this?
I would think of it more in saying that this treats pass-through entities as an entity. You're applying a tax at the entity level. So it kind of creates this middle ground between saying pass-throughs currently pay almost explicitly, or they pay on their personal income taxes, and corporations pay at the entity level, and then what's left over can get passed through on dividends and paid. And this tax type is kind of right in the middle and saying there's an entity tax like C corporations, but they're receiving a credit that removes a lot of the personal income tax liability.
So, but when we look at the pillars of good taxation, one of the things we have to consider is our, what's it called? The name, the word is escaping me.
Horizontal equity?
No, I wasn't thinking about that. Think about our competitiveness. So I want to know, if you know, how more or less competitive does the splitting the difference make us? So if somebody was thinking about either staying here or leaving or setting up a business here, what are other states doing?
Yeah, so a lot of other, sorry.
I was gonna say, was it explained by Abby already and I have to go back and listen to that and try to figure that out, or do you know?
I don't have a great sense of kind of the cross-border competitiveness arguments. I do know, for example, New York has a pass-through entity tax. Connecticut has a pass-through entity tax. Many states that already have kind of have a great deal of state-level taxation have implemented pass-through entity taxes. So I think we're one of, I'd have to go back. Abby presented a map of all of the different states in the country that have implemented these taxes, and there are a few number of states that haven't done it yet. I think there are 32 states that have currently implemented this pass-through entity tax. So Vermont is an exception among a small number of states. But in terms of kind of the competitiveness, I don't have information on that.
Is it possible to ask for that?
Yeah, and I think, so there's a decision to do this or not do this, right? And then there's the size of the credit, that also changes things. Yeah.
I inquired about a parallel question about cross-border effects, and Ted emailed me the following. Setting a PTE tax in Vermont would allow resident owners of pass-through businesses to participate in an entry-level tax. That is to say, people who, owners of a Vermont pass-through, who, for instance, were operating a business in another state. And the second observation that Ted made pertained to Vermont resident owners of non-pass-throughs are disadvantaged if the other state has a PTE and Vermont doesn't, because they are not able to get a credit for the pass-through taxes paid in other states, since we have no pass-through here. Again, I'm not sure that changes anybody's mind, but there is cross-border effects when one state and a resident of that state does business in another state, and one has a pass-through and the other doesn't. It changes the game.
Sure. And yeah, in sitting in the chair, I think in saying that I didn't have information on competitiveness, there's not a lot of good data to say that creating a pass-through, I don't have the data that creating a pass-through entity tax necessarily drives business creation into yes.
I wasn't going that far. I wanted to know how this model compares to what's available in other states.
Sure. Okay.
Okay, thank you.
Sure. And so this part of the presentation really is a chance to kind of zoom out and look at what's some trends that's happening at the national level, and also some trends in pass-through entities in net income that's reported at the Vermont level. So to start, there's been pretty substantial growth in the number of pass-through entities at the national level. They started proliferating after the 1986 tax reform in the Reagan administration, which reduced personal income tax rates. And the fun part on this graph is in the world of policy, you don't always get really clear data on how a policy change drives decision-making. But if you look at this chart here, starting almost in 1986, pass-through entities continue their sharper growth upwards and C-Corps start decreasing. And so it's always nice when things line up like that. And comparing this to Vermont, the same thing is roughly true. This graph presents less of a time series. It's limited from fiscal year 26 to 2019. Yes, and so the number of pass-throughs, and so this is not including all sole proprietorships, but there are more pass-throughs than C corporations. And the number of sole proprietorships is about 60,000. And so there are far fewer C corporations.
I don't necessarily see this as cause and effect, however. There are many reasons that somebody would choose a pass-through over a corporation. Many, many reasons.
Yes, and so this chart in particular isn't showing cause and effect. I just wanted to show that kind of at the national level, there are more pass-throughs than T corporations, and that's just also true in Vermont.
Yeah.
And so that has lots of implications for our tax base. Yeah.
Just again, a footnote on that point. S corporations are a relatively recent novelty compared to Cs. And S's, you get the best of both worlds in one sense. You get the liability, insulation of liability, but you get to own and direct the corporation directly as a partner or a limited owner.
Sorry, is there?
No, the point is,
Yeah.
some people did see because they got the liability insulation. Now you can get that insulation either way. Didn't used to be so.
And in this slide, I am showing that this is from data from the Brookings Institute, and it's showing that in line with the growth in pass-through businesses, the share of net income at a national level reported by pass-throughs is increased. That has been driven by primarily partnerships and S-Corps. And so starting in the 1980, C-Corps reported 80% or had held 90% of total business net income. And that has decreased to about 50%. And so that share has been eaten up by S-Corps and partnerships. And at the Vermont level, the amount of pass-through income on Vermont tax returns has increased. S-Corps and partnerships primarily are driving this change. The amount of Sole-Proprietor income has stayed relatively flat since 2005, whereas S-Corp and partnership income has increased from about 700 million to almost 1.2 billion dollars in 2020. A slight caveat: these are inflation-adjusted dollars. 2020, as we know, is a really wonky year in terms of income, and this is based on resident returns. So it's possible in the pandemic more people moved to Vermont, and so we showed a big jump. And it could also be in pandemic profitability. And so a summary of the income that is reported by pass-throughs in 2019, there were 58,000 sole proprietor returns, and they reported almost $900 million in business income, and that represented about 4% of the total Vermont AGI and income tax forms. And in 2019, also, there were 20,500 Vermont resident returns that reported S-Corp or partnership income, and they reported $1 billion in income, and that represented 4.6% of total Vermont AGI. And there was a JFO pass-through issue brief, and it estimated that in fiscal year 2020, these pass-through returns generated about $110 million in Vermont personal tax revenue. And so that represented about 12% of personal income tax. And it was about 6.7% of available general fund revenues in fiscal year 20. So it is a large amount of income, but as a relative share, there's a lot that's also being held in salaries and wages and other forms of income that folks are reporting.
Can you go back?
Yes.
I'm stumbling over the second bullet. So that 20,000 Vermont residents reported 1 billion in S-Corp income.
Yes.
Or partnership.
Okay, so their combined income for the 20,000 was 1 billion.
Yes.
Or, okay, got it. Good. Thanks.
And comparing this to corporate net income, this is data from the Vermont Department of Taxes. Corporate net income reported ranged from a little bit more than 600 million. It decreased in 2020, unsurprisingly, and then rebounded to above $900 million in, this is tax year 21. Key points here is that net corporate income is volatile, but in 2019, it was about a third of total pass-through net income. And overall, corporate income tax revenues represented about 6.5 to 9% of available general fund revenues in tax years 2018 to 2021. And then looking at the income distribution of different business structures and which part of folks or how folks with different amounts of income are reporting how much net income they're reporting. So this is from tax year 2019. Basically, almost half of net income reported in 2019 was reported by filers. This is for sole proprietorships, so a one owner business. Was reported by filers with less than 100,000 in AGI. And then 70% of total returns had less than 100,000 in AGI. And as you move up the scale, you see less and less net income being reported until you get to the 1 million or more, and you have only 180 returns that report about $40 million worth of net income. And then mapping this over time, you can see kind of a similar thing. The purple bar is the amount of net income reported by folks who are earning between $0 and $100,000 in AGI. Those amounts have stayed relatively consistent over time in nominal terms. Comparing this to S-Corp and partnership income, this S-Corp and partnership net income is more unevenly distributed. And so more, looking at this on the left, the higher, so people with more than $500,000 in AGI are reporting the majority of net income from S-Corps and partnerships. So you have about 1,400 returns on this table on the right, reporting almost $600 million. And folks with less than $500,000 worth of AGI, there are over 19,000 returns that reported 400 million in net income. And this is a similar graph. The colors are the same. You can see that the purple bar, which was a much larger share of sole proprietor income, has shrunk, and the higher levels, the blues and the greens, are reporting most of the income in S-Corp and partnerships. And the total amount in nominal terms has increased from $585 million reported in 2010 to more than $1 billion in 2019, while the number of returns over this time has stayed relatively constant. The amount of income reported by filers with an AGI of more than $1 million increased by the largest amount. A lot of this was driven in 2020, so flagging that there may be some noise there. And so to sum up the information that was presented here, most pass-throughs are small and pay very little tax on their profits. However, the tax base is being driven by a very small number of large or profitable pass-throughs. So this is folks with higher levels of AGI. The number of pass-through businesses and the amount of income generated by these businesses have increased sharply in the past 30 years. And pass-through income returns benefit from the discrepancy between personal income tax rates and corporate income tax rates. And finally, specifically targeting pass-through owners in a tax proposal is difficult because of the way their income is weaved into AGI on personal income tax forms. And so any changes to, hypothetically, personal income tax rates will impact the effective rates on pass-through businesses. And a change to the highest brackets would be more targeted because most pass-through income accrues to the highest income individuals. So again, more than $500,000 worth of AGI. And so that's all I've prepared for the committee today. I'm happy to answer any questions.
Yeah.
Why would you have aggregated the data in the categories S-Corp and partnerships?
Sure. So that is how the IRS reported those data.
Okay. And so, but they are then or the IRS is also giving you the ability to categorize them by size.
Yes.
And so you're able to do that, but you can't do the same thing for partnerships standalone.
I don't have those data for the IRS. I could talk to folks at the Department of Taxes to see if they report differently, but yes, at the IRS level, those are the way the data are.
And I think the relevant point is sort of like, could be subject to a pass-through, not subject to a pass-through, right?
No, they're both pass-throughs.
Yeah, I know, that's what I'm saying. So having them all in a cluster makes sense because the idea is that we're contrasting them with C-Corps, which are not pass-throughs.
Exactly.
That's what I'm saying. So I guess I'm wondering what you would want gained by
Well,
differentiating.
one, I believe the number of participating and income receiving individuals is probably different than the other. So the aggregation of this has so many people of over 500,000 income is a little deceiving because you don't know how many partners and how many participants in the S-Corp are dividing those funds. That's all. It leads you to perhaps a false deduction.
Yeah, I will.
Sorry, I'll probably decide on other bases. It's just an interesting statistical penetration, if you will, of the detail.
Sure.
Can we see it?
Maybe depending on everything else that's going on and how hard it is to get the data and all of those things.
Yes, but I will definitely see
I
what.
feel like hyper aware of the amount of weeks we have left in the session right now. That's all but that's probably just me and my Tuesday morning anxiety and not something you need to be concerned with, Carol.
Okay. Then I'll relax.
I'm all the way back on slide 8.
Could I be reminded when this is due to sunset at the national level? Because that's
Abby?
still up in the air, as I recall.
Hey, Abby.
It is at the end of 2025.
Okay. And still there's no signals as to
I think
whether that will, okay.
I think, there's signals in every direction.
Yeah, I know, smoke signals.
Right now.
Yes, I think that's where I would ask Abby. I remember she presented some of the different proposals at the national level that would augment it, decrease it, end it. Yes.
Got it.
And from my perspective, the most reliable thing we can, please forgive. I hope our incredible folks serving from Vermont forgive me for this comment, but I think the thing we can most depend on right now is that nothing will happen.
Yeah. And needless to say, ours could provide sunset if.
Sure.
Yes, and that language is Senate Finance added the language that would sunset.
What I kind of remember. Thank you.
So back on slide 8. So we have a C-Corp. So I'm trying to understand, and Abby, this is actually a question for you too, I think, sorry. I'm trying to understand how the relative different tax rates are applied to these different things. So, the income tax rate applied to pass-through income, the new tax that's created, the new tax rates that's created here for pass-through entities and the corporate tax rate. Can you talk me through those different numbers?
Sure, I could, or Abby is. I'll definitely, so I don't have the personal income tax tables in front of me, but there are different, the graduated levels of different income tax rates. And I might actually phone a friend sitting in the.
We all have our little.
Yes.
Somewhere in our desks.
Yeah.
I bet Scott will find his first.
Right, and so yes, personal income tax, there are different brackets. I go. Here we are.
Okay.
And I would have to, let me see, can I borrow
Yeah.
this? Thank you. Income phase out, other important income, federal. Okay. The personal income tax, it depends on your filing status, whether it's married, filing jointly or separately. I'm going to do single taxpayers. different tax brackets are the same across filing statuses, but you have different rates of 3.35%. And that's from $0 to $41,000, roughly $40,950. And then the next bracket is 6.6%. And that applies to income between $40,951 and $99,200. The next bracket is 7.6%. And that is from $99,201 to $206,950. And then over $206,950, the rate is 8.75% at the personal income tax level. And so that's what pass-throughs are paying currently. The pass-through entity tax rate is set at 7.6%. In statute, it's the second highest marginal tax bracket in chapter, I think it's 5822. And so that is 7.6%. And then I left up the corporate income tax tables here. Corporate income tax, the marginal rates kick in at a relatively low amount of income. So starting with $25,001, you hit that 8.5% level. And then there's also minimum taxes. So many corporations report negative income. And so the minimum tax will capture many of those folks. And that's based on gross receipts on the left.
Thanks. Anyone else? Craig, you want to jump on in? Throw anything into the mix since you're sitting there? You could have the chair if you.
Well, I mean, I don't know if I have a lot to add, but just I still been calling it the Wayfair of the 2020s, and the closest thing I've ever seen is the Hampshire state tax policy. I look forward to the committee passing.
Thank you, Craig. Will you identify yourself for the record?
Yeah, Craig Bollier, tax commissioner,
Okay.
and strong pass-through entity tax supporter.
Thank you. Okay. With that, I think we are going to take a break until 2:30. I know. I thought you all would have more questions about the thousands of charts that got put up. Yes.
Just before I leave my brain, the corporate tax, there are only essentially 3 rates, not very progressive. It's applicable to both S and C, just so we're clear. Okay.
I mean, would you like to have discussion on this? Or
Yeah,
Those corporate tax rates are. S-Corp pay business income tax. S-Corp pay business income tax.
I can't hear what he's.
Oh, they don't make.
Okay, wait.
Sorry.
We can actually have
I'd
a,
like to hear what was just said.
okay, let's
sure.
pause one moment and gather ourselves. Okay, or I'm gonna gather myself at least. Do we have any further questions for Ted? Okay, you are welcome to get up and move on with your day or stay on the sidelines or whatever it is. And it sounds like Representative Anthony had a question and we have no further questions for Abby. Okay. Were you waving her? You always, every time, Jim, you confuse me with that one. Okay, bye, Abby, thanks. Or did you want to jump in and say something?
May I just offer clarifying? I'm not sure.
Please do.
Couldn't hear everything that was happening on the sidelines. So I just want to clarify that the corporate income tax only applies to C corporations.
Yes.
Okay, thank you.
Thank you. And Craig, was that what you were saying on the sidelines? Great, okay. And do folks want to spend some time talking this all through?
Spend some time.
I feel like I'm not ready.
Discussing before we take a break? Or, yes.
Good so far.
I think for me, it is definitely frustrating that different entities have access to different rates that allow for sort of workarounds that maybe minimize federal tax liabilities.
Kurt,
And
can you hear
I kind
Catherine?
of imagine if we dug into any number of the existing federal tax loopholes, it would be incredibly frustrating. And yet, I do find Commissioner Bollio's argument compelling that how I feel about the existence of this pass-through entity, it is something that exists. Other states are taking advantage of it. The federal government has blessed it. It would reduce tax liability for certain few Vermonters who have significant partnership income, while also potentially generating more state revenue. And as much as I guess, wish that that tool wasn't available to few, this does feel like it's an opportunity to reduce federal tax liability for Vermonters while increasing state revenue at the same time, which is pretty close to a free lunch.
It's pretty close to what?
A free lunch.
Free lunch, yeah.
Representative Anthony.
I was against it to begin with. And I did warm to it after I realized that the credit percentage is, if you like, in the game. I understand Connecticut has the lowest amongst the states at 87.5, if memory serves. That provides a bit more money for the Vermont General Fund. And so on that condition, and if it sunsets, if Congress lets it sunset, I'm in.
And so there are various levers here that we haven't really talked about very much yet, right? There's the size of the actual tax in the bill that could be, moved around to match other rates that might be more appropriate given who's mostly paying it. There's the amount of the refund, which could be lower or higher. So there's still, it's not, I think there's the moral, I guess, aspect of the bill that you spoke to, Representative Sims, that I continue to be incredibly uncomfortable with. But just the idea that we're helping people essentially legally evade federal taxes in the face of the largest wealth gap that maybe the world has ever seen. But everyone else is doing it. Yes, Representative Anthony.
Yes, that's where I think Representative Odie's request for comparatives would help me think about. I've only thought about the credit percentage, but I haven't thought about the other effective rates that would be applicable. And I should think about that before I say goodbye.
Yeah.
I'm generally a supporter. I'd like to see how the levers work out. Mm-hmm. On those specific levers.
Anyone else? Okay, we will ask JFO to play with some levers, and I think the commissioner also has some thoughts on levers, and so maybe we can look at that and then come back and regroup on it.
I do like the idea of the reducing the credit a little bit.
Great. Thanks, team. See you at 2:30.